Earnings week continues with the tobacco and high-yielding giant Altria Group, which just reported their earnings before the market opened, and we can see they are down nearly 6%. Now, when we digest what they did release, unfortunately, for a quick spoiler alert, it was a double miss. Their earnings per share came in at 131 when the analysts were targeting 135. That is a 4 cents earnings per share miss. And when we look at their revenue on an adjusted basis, 5.28 billion, and as we can see, the expectation of 5.43. Now, granted, they did have a double miss. They do, however, expect the full year earnings to remain unchanged at the 507 to 515 level. Now, when we actually look at the numbers, not just compare it against analysts, but also on the same quarter in 23, unfortunately, the 6.2 billion that they generated on the top line did come lower at 4.6% from the same quarter in 2023. And when we look at the net revenue for the first half of 2024, so the first 6 months of just under 12 billion, we can see that is also lower by 3.6% than the first half of 2023. Unfortunately, the poor numbers do continue when we look at the adjusted earnings per share, 246 for the first half of 2024, whereas what we have noticed, that is still lower by 1.6% than the first half of 2023. Now, when we have a very quick look at the numbers, well, in fact, they are down, as we mentioned, nearly 6%. However, over the last year, they still are up around 11%. Over the last 10 years, if you have been a shareholder, you would be up only 21%, not the greatest, but again, it doesn't include dividends reinvested, something we will touch upon today. And what we want to understand with the drop for a company, as we're about to find out, now pays a yield after the drop of over 8%. Is it one we should add, especially as we are anticipating rate cuts to start in September? Therefore, a lot of money that right now is sitting on the sidelines, getting around the 4 to 5%, may be more inclined to come into the attractive companies like Altria, where the yield does sit at a very nice 8% point. Now, in terms of the 52-week range, it is still in the upper end of the 52-week point. We do get a double buy, again, a hold from quant. That seems to be a regular theme. And we do note the forward P does sit below 10. Now, you can't compare it to the S&P, but as always, for those that are interested, the S&P's forward P sits at around 23. Now, let's dissect the numbers, what is under the hood. Now, as we said, 8.14% yield. Unfortunately, the dividend does have a borderline safe score of 55, so let's touch upon that. And what I quite like with the company, granted it does pay a very high yield, you would think maybe we would see mediocre increases to the dividend, but you get at least an inflationary rate of around 4.3 in the more recent year, and we will see a regular theme when we expand that to over the longer term. What this effectively means, a borderline safe score of 55, there is a moderate risk of a dividend cut over a full economic cycle. Now, for those that believe a recession is inbound, well, the Great Recession of 07-09, they actually increased the dividend, always a great sign. They did, however, have negative 50% recession sales, well below the average of the S&P at negative 12. But on the contrary, they massively outperformed, negative 20%, with the S&P coming in at negative 55. As we mentioned, a marginally above inflationary increase in August 23, 5% over the last 5 years. Remember, on this channel, we want a minimum of 4%, as bear in mind the US inflation rate over the last 40 years has been around 4%. So if you're getting less in your dividends, your salary, other income producing assets, you are in fact getting a pay cut and losing your purchasing power. And as we can see, over the last 20 years, it has been fairly poor at 20%. Hopefully, we can continue to see the above inflationary rates we have seen over the shorter term. They are also a dividend king with more than 50 years of consecutive increases to the dividend. Now, dividend yield theory, as always, something we do like to look at on this channel. It states a company is undervalued when the current yield sits above the 5-year average. And what we can see here, 8.24 versus 8.16. So you could argue after the 5% drop today, this has entered now reasonable territory. In terms of the forward P as well, 9.2, pretty much bang on the 5-year average. So therefore, again, another sign of reasonable valuation. But as always, we never look at any of these models in isolation. We'll conclude towards the end. And we do note the consumer staple sector sits significantly higher at 17.3. Now, first things first, the free cash flow payout, very important for a company that has a very high yield. we want to draw your attention to the free cash flow, as the earnings data is susceptible to manipulation by management through accounting. Now, below 85% for tobacco companies, our blanket rule 60% or lower. Just give us faith, management can offer some very nice increases to the dividend. Nice to note for Altria, below 80% pretty much every single year from 2018. Previous to that, some very high numbers, but since then looking good, 63% in 2023. Anticipated to go a little bit higher at 87 over the next 12 months. Something to bear in mind, and we can start to see why we do get that borderline safe score. In terms of free cash flow per share, what do we want to see? Well, consistent increases over the longer term. Nearly a 3 times increase from 2014 to 2023, which is very nice to note. But do bear in mind, over the next 12 months, this is anticipated to drop down to 451. Now, something that is a recurring theme in this industry, whilst we do like to see 3 to 7% growth on the top line, a lot of people do argue it is a dying industry, a lot of governments looking to ban the sale of tobacco, and therefore it does really show when we look at the numbers, not really seeing a lot of growth, especially over the last few years. 2021, 1%, 22, negative 2%, 2023, negative 1%. So, do factor this in. We will consider this when we do look at the margin of safety. Nice to know that over the last 12 months, it is on 11%. So hopefully for the full year of 2024, we will see some very strong numbers. And again, numerically, this does show when you do factor in that inflation of 4%, you could argue that Altria's top line is barely increasing, if in fact not decreasing. One thing that we do like a lot is when companies return excess cash, something that Altria have done, especially over the more recent period, with the notice that they will be doing a lot of share repurchases year on year, quarter on quarter. Over the longer term though, when you do look at it from a historical basis, it is very minimal, so something just to bear in mind. But as always, this is just a nice bonus to investors on top of the yield and a nice dividend increase. ROIC, very important metric, one of our favorites. We want to see 10% or more. Give us faith, management are able to effectively allocate their capital. 15% if you want to be industry specific for tobacco. Not only has it been increasing, but some very strong numbers, 48% over the last 2 years, 53% on a trailing 12-month basis as well. This does make it incredibly attractive for investors to consider purely off that metric. Operating margin, now what do we always say on this channel? High quality companies that can continue to increase their top line revenue but also improve their margins. Now their revenue, there is a question mark around whether they can continue to increase it, but margins looking very strong, 44% in 2014, 59% over the last few years, and if they can continue this with revenue starting to decrease, this is one way that they can continue to increase that borderline net income that we will come to shortly. In terms of free cash flow margin, well, a free cash flow machine, just look at the numbers over the last few years, 44% in 2022, 53% in 2023, and a lot of people always ask whether or not this is a stronger company than British American Tobacco, but when we do look at that, a lot of metrics we do see very poor in comparison to Altria, so do bear that in mind. Whilst BTI may be one to consider in this market, its metrics, in our opinion, when we have compared it, do look worse off. Finally, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 3 is what we want to see for tobacco companies. Bear in mind, this correlates strongly to dividend safety, balance sheet strength, and the numbers that you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. We love to see the fact that it has been decreasing from the highs of 2018, 1.79 in 23, 1.7 expected over the next 12 months. So in reality, you could argue, even though the payout ratio does look high around the 87% level, given the strong net debt to EBITDA levels of around 1.8 to 1.7, the dividend for now, based on this information, does still look to be safe according to what we can see in front of us. Next thing that we do like to look at is insider as well as institution movement. Have they been buying? Have they been selling? First things first, insider ownership 0.09%. We see just under $1 million worth of sales over the last 12 months, with very trivial amount of buys during the same time period. But we also note in quarter 3, no buys or sells. You have to go to the previous quarter to see the sale of just under $1 million. And when we take a look to see who these insiders have been buying or selling, we can in fact see on the 2nd of May, so you could argue a little bit outdated, the vice president did sell over 22,000 shares, netting him a cool $988,000. Now bear in mind, insider selling isn't something we would consider to be a bearish signal. As always, they sell for many reasons, whether it's personal or financial, but we have just shown this for the full transparency. Institutional ownership then sitting around 57%. We see just under 3.8 billion worth of sales over the last year, with a little bit less worth of buys at 3.5. And when we do look at the more recent quarter, the same to be said over this piece, 162 million sales versus 89 million. So overall, insiders are selling, institutions are also selling more than they are buying, but we always believe you should always do your own due diligence, never copy insiders or institutions, and always have a very solid investment thesis before executing on any of these stocks. Now, just before we continue, to let you know, we have released our latest articles. Now, for those of our paid subscribers, we have released August undervalued stocks, and you will have access to 35 stocks that we do believe to be considered a buy this month. The first one, as you can see, is Visa, and we also run through each one depicting which ones are within our portfolios. Now, for those that are just free subscribers, you do have access to many articles running through other undervalued stocks as well as other financial news, and you can grab a copy by clicking on the pinned comment below, and it is straight away instant access. Now, we want to very briefly look at the income and balance sheet. First thing to note, as we mentioned, the top line revenue has been increasing very marginally. Now, we did go through this. If you factor in inflation, you could very well argue that the top line is decreasing. But what we really want to point out from the income statement today is, does the bottom line net income tell us a different story? Well, it's gone from 5.1 billion in 2014 to around 8.1 in 2023. So that is some nice growth, but do bear in mind when we look at it from a graphical standpoint, there is a lot of inconsistencies on a year-on-year basis. Again, something that we would say to consider in your margin of safety. And then we like to move on to the health of this company, a quick cash versus total debt comparison. 3.3 billion of cash in 2014. 3.6 in the latest quarterly report, so very marginal movement, and again when we look at it over the last 10 years, very inconsistent. Now, this number, as always, in isolation tells us nothing, which is why we compare it to the total debt numerically and directionally. And what we can see, it has increased from around 15 billion in 2014 to around 25 in the latest quarter. But as we did have a look at the net debt to EBITDA, it does sit around 1.8 to 1.7. So far there are no issues over the long-term health of Altria Group. Next thing we want to look at is the earnings, how they performed previously, how they're estimating for the future. Over the last 4 quarters, not the greatest, given the fact that Q2 they just released, they missed. So in fact, 2 of the last 4 they have missed, with the other 2 just being in line. So you could argue that in fact maybe you need to take some of their forward estimations just with a little bit of a pinch of salt. And we do note over the next 3, they are anticipating around mid-digit increase to the EPS year on year. And if they do hit the December 2025 estimate, the forward PE will come down to around 9.6. Again, that will depend on whether or not you do have confidence in what management do see over the next few quarters, given they did just miss that recent one. We then look at some gradings. Now, the first one is a valuation where they do get an A. One of the reasons for this, well, if we look at the P on a non-GAAP basis of 9.9, they trade at a significant discount to the sector, in fact a 43% discount, and that pretty much is the same when you do look at the majority of valuation metrics. So this is one though that you could argue deserves to trade at a discount, but as always, something that we will cover when we look at other metrics. For example, on the growth, they do get an F. Now, some of the reasons for this, year-on-year revenue growth, well, 11%, that is nice to note, especially given the sector is low single digit at 2%. Moving forwards, over the next year, they're anticipating pretty much flat, whereas the sector is looking at 3.44. And one of the things that we always draw your attention to, where the F grade probably was driven by, is the earnings per share over the next 3 to 5 years. They're anticipating a year-on-year increase of around 4%, while the sector sits at 7.93. Now, it's not all bad news when you compare it to the sector, because their profitability grade, they do get an A+. When we look at the gross profit margin, phenomenal at 70%, with the sector at 35%, and the bottom line as well, very strong, 41% when you look at the sector median of 4.4. And the final thing we want to draw your attention to is the cash from operations, just above 9 billion when the sector is sitting there at 781 million. Now, a quick conclusion for this part of the analysis: a double buy with the hold from Quant, an A on valuation, an F on growth, and an A+ on profitability. Now, before we jump into the valuation itself, we want to compare how this company is done to others in the tobacco industry. We have the popular British American Tobacco, Japan Tobacco, as well as a few others. And what we can see now, this is total return, so it includes reinvesting those dividends. Altria Group is pretty much in the middle of the competitors, up around 16%. We can see BTI pretty much very similar at 15.4%. Now, when we expand this over the last 5 years, what we do note, again, a very similar performance, up 49%. Again, BTI not too dissimilar at 47%. And when we zoom out to over the last 10 years, we can see they are the second best performing, up 116%. BTI, in comparison, very poor performance over the last 10 at 13% positive. But as always, do bear in mind this one thing, that past performance is never an indicator of future. They could perform much better. They could also likely perform much worse. And as always, just to keep things consistent on the channel, we want to compare it to the S&P. Now, over the last 12 months, interestingly, maybe not a lot of you would have realized this, but the S&P has actually underperformed Altria Group, 18.47%, with Altria up, although marginally higher, at 22%. When we expanded over the last 5 years, we do see the flip side now, with S&P outperforming at 80 versus 56, and over the last 10 years, some significant outperformance by the S&P. Now, as always, we do like to mention that if you don't believe over the longer term that Altria Group will outperform the S&P, you could consider a low-cost ETF. We do also understand that a lot of investors in Altria or British American Tobacco actually use the very high yield for their own expenses, so maybe total return isn't one of their considerations, but as always, for transparency, we do like to keep it consistent. Then let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And our intrinsic value today comes at just over $51. Now, how we got to this, we run through all of the models. Now, the first one is Graham's valuation. We have the stock ticker symbol, we have the EPS, long-term growth rate, and the AAA corporate bond yield. And we do get our first undervaluation signal. That, as always, bear in mind, we don't look at any of these models in isolation. We then have the second model, the multiples valuation. We have the companies we looked in the similar sector and size, average P multiplied by the EPS of Altria to get our intrinsic value with another undervaluation signal. Now, today's episode, we will exclude the multiples valuation, as Altria does trade at a much lower valuation than the sector, and therefore we believe it will highly skew the data. But if you want, we have shown this, so you can include it if you want to do the calculation yourself. We then have the dividend discount model, with the very nice increases over the last few years. Average growth at just over 4%. We want to be incredibly conservative, so 0.5%, and we do get another undervaluation signal. We then move to the DCF model with the free cash flow year on year. Average growth at around 12%. Now, we want to be conservative, but also understand the way this industry is heading, so we have gone for negative 4%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, another undervaluation signal, although you could argue reasonable valuation given it isn't too far off the market price. Now, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Altria or any other company that you wish to do so. So Wall Street, firstly, do see upside of 2%. Their price target of $49 does indicate that this one could be a buy. However, that may be more inclined for those that do want the yield of around 8%. Remember, as we said, with the impeding cuts to the interest rate, this could become a lot more attractive for a significant number of investors. Now, as always, on this channel, we like to do a margin of safety, 10%, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if they hit that, then you could argue this is a buy up to around $46. So right now, we don't see a 10% MOS. At 5%, that is pretty much where it is sitting at right now, where a lot of investors may not be inclined to consider it at this level. For those that want to see around 15%, well, it would be a buy at around $43, and those at 20% would have to wait for around $41. So as we said, right now we only see a 5% MOS, with Wall Street considering very minimal upside of around $49. As always though, do let us know your thoughts in the comments below. If you have enjoyed this episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget as well to subscribe to the newsletter so you do get those undervalued stocks, and also join us in the Patreon if you want to see the weekly buys and sells. As always, have a great day, and we'll see you all on the next one.